Yeah, it is definitely driven by technical factors because the market on Friday had this huge option expiration. And as a lot of the short positioning in puts was taken out, there was actually a lot of room left for the market to test more downside. I think when we came in on Monday, that was that reversal of pattern as you described. The previous week was more of a sell-off in the afternoon. Now we got the sell-off in the morning. And there's some analysis on this that there was particularly fair amount of retail selling coming through for the first time. I think that contributed to where we hit the trough during the intraday session. And the reversal really happened when there was some talk about that this pattern with Ukraine, the tensions may not be leading really to a real military standoff. And that was somewhat of a trigger to get markets lifted. Ultimately, I think the institutional buyers came back. But historically, whenever the NASDAQ in particularly reversed an intraday loss of about 5% to positive, if you think of the year 2000, year 2008, when that also happened, the history is not very friendly. So I think the market is still very wary of where we are, why we are still negative this morning.
Well, there was really incredible chatter yesterday talking to investors, people who were involved in the market, saying, the market is imploding. This is what the end of a bull run looks like. This is the bubble popping. But I wonder if the bubble, if there is a bubble, and this is where we're heading now, we're heading toward the end of a bull run. Will the bubble pop, or is it more likely to be a sort of bubble deflating type of scenario? What does the path forward look like if this is the end of the bull run?
Yeah, I would be more on the deflating side, and you can actually see this in what I call thematic tech, right? This is where the pandemic caused a lot of companies that were not profitable or innovative companies, technology companies, to inflate in value so much. If you put that on a scale like normalized since the start of the pandemic, you can really see the bubble there. If you think of, say, big ETFs like ARK, Innovation ETF has been sort of as the benchmark of that. But yeah, that was a really inflated value and it's coming off really sharply now. It's also notable that a lot of those companies are now back to almost party to where we started at the pandemic in terms of when they increased so much in value. So we've made a round trip here. Whereas the big technology is really about earnings, as you described earlier. The earnings EPS growth was so significant in 2020 into 2021. That's in a year-over-year base effect coming in now. So the earnings will be discounted as a negative. Why that big tech stays under pressure? I don't think that's a deflating of bubble. That's more of a realization of aligning the price with an earnings forecast that's more in reality, that's more normalization. So I think that's what we can expect in a few days. And if you watch yesterday, Apple indeed ended up negative, but so did Tesla. And that will be a big focus, I think, today as the earnings of that company come in, since there's been so much hype on big names like Tesla.
And Ben, Rosanna joining the conversation here. I hear your point earlier about the gamma squeeze. Always a fan of looking elsewhere for the technical sort of suggestions about what might have been happening in the markets. But let's talk about what happens when you get options expirations actually kind of conflicting with major geopolitical events like what we're seeing on the border between Ukraine and Russia at the moment. What type of effect does that have?
Yeah, you get the flight to safety effect on the markets. And although the yen and treasuries and gold didn't rally as much as you would normally expect, I think what really happened on the equity side of the market was that there were people complacent, maybe selling puts, as the market went up each time and volatility was low, and that ultimately, as you mentioned, gets squeezed out. And what then happens is then that all the dealers who are on the other side of that trade have to cover that by selling the underlying index, and that puts so much pressure on the market starting on Friday, going on yesterday, and even I think today. So there's some of a washout on that positioning. And the next big expiration is on February 18th. So these option expirations are suddenly becoming risk events, we say, right? And because of the tension with Ukraine and Russia is not faded away, even though some chatter of yesterday that may not be so severe, we cannot discount that will be away. So the geopolitical tension will overhang the market and then drive the technicals to this accelerated selling.